Priya had $11,000 sitting in a savings account that paid almost nothing, and she'd known for over a year that she was supposed to do something with it. But every time she opened her banking app to look at it, she closed it again 10 seconds later, overwhelmed by a decision she didn't know how to start making. It wasn't a lack of money that was holding her back. It was not knowing which of the 50 things she'd read about was actually supposed to happen first. This video is about that exact gap, the one between having saved money and actually investing it, and the specific order those steps are supposed to happen in. Most people think the jump from saving to investing is a single decision. Close the savings account, open a brokerage account, done. They're completely wrong, and the reason matters, because treating it as one decision is exactly what causes the paralysis in the first place, when in reality it's a sequence of steps, each one setting up the next, and skipping the order causes far more damage than skipping any single step entirely. The first step, before any investment account gets opened at all, is separating savings into two distinct purposes that most people accidentally treat as one. There's money that exists to be spent soon, whether on an emergency, a planned purchase, or simply living expenses in the near term. And there's money that exists to grow over a long horizon and isn't needed anytime soon. Priya's $11,000 was actually a mix of both. Without her realizing it, roughly $6,000 she'd genuinely need if she lost her job or faced a medical bill, and $5,000 that had simply been accumulating with no near-term purpose at all. The first real decision in this entire path isn't, how do I invest? It's which portion of what I've saved is actually available to invest. And getting this split wrong is the single most common reason people either invest money they need soon, or leave money sitting in savings for years longer than necessary out of fear of touching it. The second step is establishing the actual size of that near-term portion, commonly called an emergency fund, which for most people means somewhere between 3 and 6 months of essential living expenses, sitting in an easily accessible account rather than tied up anywhere else. This isn't a competing priority to investing. It's the foundation that allows investing to happen safely. Because without this buffer, an unexpected expense forces a choice between debt and selling investments at whatever price the market happens to be offering that day, which is frequently the worst possible day to sell. Once this number is calculated and set aside, everything remaining is genuinely available for the next step. And for many people doing this calculation for the first time, that available amount turns out to be smaller than expected, which is a normal and useful thing to discover early rather than after money is already invested. Before moving further, there's a question that comes up constantly at this exact stage, and it deserves an honest answer rather than a dismissal. What about existing debt? Does that get paid off before any of this begins? The honest answer depends entirely on the interest rate attached to that debt, and treating all debt as identical is where a lot of advice goes wrong. High-interest debt, typically anything above roughly 7 or 8%, functions as a guaranteed negative return, meaning paying it down produces a certain, immediate benefit that's difficult for any investment to reliably beat. So this type of debt generally gets prioritized before additional investing beyond an employer match, if one exists. Lower interest debt, something like a mortgage in the 3 to 5% range, behaves differently because historical market returns have often exceeded that rate over long periods, meaning there's a reasonable argument for investing alongside, making minimum payments, rather than aggressively paying down that specific debt first. This isn't a universal rule that applies identically to everyone. Personal comfort with carrying debt matters too. But the interest rate is the honest starting point for that decision, not a blanket instinct to eliminate all debt before investing a single dollar. Here's where this gets genuinely interesting, because the next step is the one almost everyone assumes comes first. Choosing what account to actually put investment money into, and this decision matters more than most people realize before they've researched it. A retirement account offered through an employer or opened independently provides a tax advantage that a regular brokerage account simply doesn't, either reducing taxable income now or allowing growth to happen without yearly taxation, depending on the specific account type. The mechanism here is straightforward but easy to underestimate. Money that isn't taxed every single year compounds faster than money that is, because the amount that would have gone to taxes stays invested and keeps growing alongside everything else. Within this step, there's a specific decision worth walking through directly, the choice between a traditional structure and a Roth structure, since both are common and the difference confuses people constantly. A traditional account reduces taxable income in the year money goes in, but withdrawals in retirement are taxed as ordinary income. A Roth account offers no upfront tax reduction. Contributions go in after tax, but withdrawals in retirement are entirely tax-free, including all the growth that happened along the way. The mechanism that decides which is better isn't complicated once it's named clearly. It largely comes down to whether someone expects to be in a higher or lower tax bracket in retirement compared to right now. Someone earlier in their career, likely in a lower tax bracket than they'll eventually reach, often benefits more from a Roth structure, since they're paying tax now at a lower rate in exchange for tax-free growth later, while someone in their peak earning years, in a higher bracket now than they expect in retirement, often benefits more from the traditional structure's immediate deduction. Neither choice is wrong in isolation. They're simply optimized for different situations, and understanding this mechanism matters more than memorizing a rule of thumb. There's also a specific account worth naming that often gets overlooked entirely in this conversation. A health savings account, available to people enrolled in certain high-deductible health insurance plans, which functions as arguably the most tax-advantaged account available, offering a deduction going in, tax-free growth, and tax-free withdrawals for medical expenses, a combination no other common account structure matches. For someone with access to this account type, it often deserves consideration even before maximizing other retirement accounts, specifically because of how unusually favorable that triple tax treatment is. Someone might reasonably ask why not simply skip the retirement account structure entirely and use a regular brokerage account for everything, since it offers more flexibility. It's a fair question, and flexibility genuinely does have value, particularly for money that might be needed for a major purchase before retirement age. But the honest trade-off is that the tax cost of skipping this structure compounds silently over decades, and someone who fills their tax-advantaged accounts first, then uses a regular brokerage account for additional investing beyond that, generally ends up with meaningfully more money at retirement than someone who used only the regular account, assuming both contributed the exact same total amount. Flexibility has a price, and knowing that price exists is what allows someone to make an informed choice rather than an accidental one. The next step is choosing what actually goes inside that account once it's open, and this is where the earlier reframe about picking individual stocks applies directly. A low-cost, broad-market index fund, one that holds hundreds of companies at once rather than betting on any single one, removes the need to predict which specific business will perform well, which is precisely the guess that trips up even experienced investors. Historically, these broad indexes have returned somewhere around 7 to 10% annually before inflation over multi-decade stretches, not because any one company drove that number, but because the average of many businesses tends to move upward over long periods, even as individual companies within that average rise and fall unevenly along the way. Within this step, it's worth addressing how that fund choice might reasonably shift based on how far away the money is actually needed, since a 25-year-old and a 58-year-old shouldn't necessarily hold an identical mix. Money with decades before it's needed can typically tolerate more short-term ups and downs in exchange for higher long-term growth, which usually means leaning more heavily towards stock-based index funds early on. As that time horizon shortens, gradually shifting some portion of the portfolio toward more stable holdings, like bond funds, reduces the odds of a poorly timed downturn causing serious damage right when the money is actually needed. This isn't about predicting markets. It's about matching the volatility of the portfolio to how much time exists to recover from a bad stretch. And target date funds, which handle this gradual shift automatically based on an intended retirement year, exist specifically for people who'd rather not manage that adjustment manually. The final step, and the one that determines whether everything before it actually works long-term, is automating the whole process so it repeats without requiring a fresh decision every month. This connects to something well documented in behavioral research. Consistency drops sharply when a decision requires active willpower every single time it's made, but holds far more reliably when the decision is made once and then automated going forward. Setting up an automatic transfer, even a modest one, removes the need to feel motivated on a specific day each month, which turns out to matter more over the following decade than the exact dollar amount being contributed, particularly in these early years, when consistency itself is more valuable than the size of any single contribution. Someone might reasonably ask what happens once this system is running, whether there's anything left to actually do, or whether the process becomes entirely passive from here forward. It's a fair question, and the honest answer involves one piece of ongoing maintenance worth naming directly: rebalancing. As a portfolio grows over years, different holdings inside it grow at different rates, which gradually shifts the original intended mix, and periodically returning that mix back toward its original target, typically once a year rather than constantly, keeps the overall risk level roughly where it was designed to be. This isn't a complicated task requiring frequent attention. It's a once-a-year check-in that fits inside an otherwise hands-off system without contradicting the idea that the process, once set up, mostly runs itself. To see how this sequence actually plays out over time, it helps to walk through what happens for someone following these exact steps starting today. In year 1, after the emergency fund is established and a retirement account is opened with an index fund automated at $300 a month, total contributions sit at $3,600, with growth adding somewhere around $130 on top of that, a number small enough to be easily overlooked, resembling the early, unrewarding stage of learning any new skill, where the technique is developing even though the results aren't yet visible. By year 7, contributions total roughly $25,200, but compounding has added closer to $9,000 in growth, meaning a single year of growth at this point is beginning to rival what an entire early year of contributions used to add, which is typically the stage where the account stops feeling like a container for deposits and starts feeling like an independent, second source of accumulation working quietly in the background. By year 15, contributions reach roughly $54,000, while growth has compounded to somewhere near $42,000, meaning growth is now producing nearly as much as total contributions ever have, a threshold that tends to shift how someone relates to the entire process, less like ongoing sacrifice, more like tending something that's largely sustaining itself. Someone might reasonably ask what happens to this entire structure during a market downturn, since a 15 or 20-year path rarely avoids one entirely. It's a fair concern, and the honest part of the answer is that existing holdings genuinely do lose value temporarily during a downturn. That decline is real and shouldn't be minimized or explained away. But automated contributions continuing through that same downturn are buying into the market at lower prices, meaning the specific conditions that feel worst in the moment are quietly benefiting the ongoing contribution side of the equation. And historically, investors who kept contributing through downturns have outperformed those who paused or sold entirely over a long enough time horizon. This isn't a claim that downturns are secretly good news across the board. It's a narrower, more honest claim that new contributions specifically benefit from lower prices, while existing money still experiences the real, temporary decline. By year 25, following this same path without deviation, contributions total roughly $90,000, while growth has compounded to well over $180,000, meaning the majority of the final balance was never directly contributed at all. It was produced by time acting on money that was simply structured correctly and left to compound. So if the actual question is how saving turns into investing, the honest answer isn't a single dramatic decision. It's an ordered sequence that builds on itself. Separate near-term money from long-term money, establish a real emergency fund, address high-interest debt before investing beyond an employer match, choose the right account structure before choosing what goes inside it. Select a simple, broad market fund matched to your actual time horizon rather than guessing at it. The math doesn't reward getting this perfectly optimized on day one, and it doesn't punish a slightly imperfect starting point either. It simply rewards following the steps in order and letting the sequence run for as long as someone allows it to.